If you look at the last 15 years in oil and gas, the last 5 have been wild with over 5 public deals per year. And the 10 years before that, it was more like 2. So I guess that's the question. What drove that? And whatever drove that, and I think we all have opinions, is that still around? Can it still happen? Or are we getting caught up in regulatory things and really there aren't as many targets and the synergies aren't as obvious as they used to be?
Sure.
Yeah, go ahead.
I'm happy to. Well, so we want to talk about the energy industry just for a moment, and and that's why I deal in day to day and known Chip for a long time. The energy industry is a hugely fragmented industry. That's kind of what we're talking about in terms of concentrations. And if we went back, it's a little bit. These numbers may not be exactly right, but directionally they are right, which is 10 years ago, there was probably literally 50 public E&P companies that were worth, somewhere between 1 billion and 1 billion and 50 billion, if you will, and probably another 20 or 30 private companies. So that's, if you look at any industry, that's a hugely fragmented industry. And then what's happened is the shale boom has matured. There's been intense consolidation among that industry for better inventory, lower costs, et cetera. So the number of that public companies that I just pointed out probably is 1/2, and also private companies that it was 10 years ago. And so there's just far fewer companies. And I think we'll continue to see that consolidation with the maturity of the energy industry. And then it's just the day-to-day, and we can get into what's causing that, but it's really that.
Yeah, so you had the consolidation wave last year, and a lot of those deals I was talking about that got kind of held up with the FTC, they all now have been cleared out. And so coming into this year, the question was, okay, so all the consolidators now are not stuck with the regulatory burden of having a pending deal, and they may be going to the next one. And so there was a lot of expectation that, the smaller independent companies might be the next target of some of these larger companies. And I agree with you. I think eventually that will happen. It's just the one thing about M&A is you need some level of certainty. You need people that feel like they can put a value on their company. We may not all agree on what it is, but it's within a give or take. When you have the VIX over 50%, how can you possibly understand what your company's worth, whether it's in the energy space or anywhere else? And I think that's why you've seen this complete pause in the M&A market for the first quarter.
And maybe I just touch on that if you'd like, because Stephen nailed it in what I was going to say. So from an M&A standpoint, we really look at 4 items that are really key for strong M&A. One is high valuations. You want to sell your company when valuations are high. That's pretty simple. Okay. The second thing is you want strong capital markets, both equity and debt, because a lot of times the acquirer needs to raise equity or debt to buy the smaller company. The third thing, which we kind of touched on, is a regulatory favorable environment, or you don't want to go into because of course you don't go to the regulators until you go ahead and have a definitive merger agreement, but before closing. Just get to that, I think, as all of you know, your directors, get to that definitive merger agreement is really, really hard. So you don't want to go into that thinking you're going to get held up by regulatory authorities. So you got to have somewhat of a favorable environment. So that's the third thing. And the fourth thing is volatility. And I don't know if you all follow it, but from an investment banker standpoint, what Stephen just mentioned is the VIX. That's the Chicago Board of Options Exchange, VIX. Is a measure of volatility. We like that measure to be in the high teens or the low 20s, certainly. And you can look at it, CNBC on their website. There's a measure of VIX, and I look at it daily. Just to give you, and we can talk a little bit what's happened in the last 2 weeks, which is pretty amazing. That VIX for a long time had been in the high teens or maybe low 20s, which last year was really, really good. The VIX, just to give you a feel when you get into what's going on in the last 2 weeks, The VIX last Friday went up 50% in one day. The VIX was over 50 to kind of give you a feel. The VIX before what happened midday yesterday, the VIX at the beginning of this week was higher than oil prices. The VIX was higher than, that is a bad stat. I'll just tell you right now. And so then we get into the issue is I was talking about earlier, year over year as of quarter end, that volumes were down. Well, because the VIX is so high right now, of course, whenever you buy a company, you know, there's two things that go into it, is your own forecast, which hopefully you're relatively comfortable about and you have confidence. But then you're buying a company, and I mean, you all are directors, you know, you're not totally sure. You do all kinds of diligence, but you don't have the same level of confidence in terms of the future projections. What you all tell me right now, but I think right now, taking future projections from a target, it's virtually impossible. I mean, you know, please tell me where the tariffs will be in 90 days in any country. And so, you know, unfortunately, I'm telling a lot of people, and I know Stephen got a couple of calls and so on and so forth. My view is the next 90 days will be a great time to go on vacation. I mean, candidly, we are working on several M&A deals right now, but and some of them may happen over the next 90 days. And I was joking a little bit, but part of that is inertia and so on and so forth. It is going to be a lot harder until we get the VIX down and more stability. And I'm sure we will do deals. I'm certainly working on two very active ones that hopefully we get done. But for the most part, you know, all joking aside, with this high of VIX, it gets much more difficult. And that's energy industry, that's a widget manufacturer. So that's, if you haven't been looking at that, I would suggest to you all, that's a really good statistic to start looking at, because it's something that, you know, frankly, people haven't talked about very much in the last 6 to 24 months. And the reason is the VIX has been low and people kind of took it for granted. VIX is really high right now. And so it's going to be discussed a lot here over the next 90 days or until things get settled.
Yeah, as an M&A lawyer, that's one of the key metrics I look at every morning. And it was interesting yesterday, the VIX itself was so volatile yesterday. I mean, to Tim's point, it was in the high 50s. The announcement comes out and it literally dropped to, I think, in 24 points. So when you have a volatility index that is itself extremely volatile, that just tells you the environment that we're looking at. I hope Tim's not right, because I don't want to, I've moved to Skadden about 2 months ago, so I don't need to go on vacation in the next 90 days. But I do think, and we were talking about this in the prep, there are some deals that can be had, but we think that, I think Tim agrees with us too, that most of them will be, you know, stock for stock transactions where it is less about, you know, is this now the right time to sell the company, or is this the right time to pay a premium for a company and use cash? You know, there's a relative valuation, and if you can get comfortable with the relative valuations of companies, even if the stock price is low, then I think those deals can get done in this market.
Yeah, I can comment on that. So what Stephen's kind of talking about, so what kinds of deals are we working on generally right now? And what kind of things are getting done? It depends on the sector, but fewer, well, as I talked about, a high market, pretty simple. There's nothing wrong with selling for cash. Now, in my industry, again, in energy, oil prices have come down, so we're not seeing near as many oil deals as we did. We have announced a couple of very large oil deals, frankly, already this year. But that was before we've seen the slump in oil over the last 30 days, 60 days. We are seeing, may interest some of you, is that natural gas is having a real renewal right now. And of course, chips on the board of, frankly, the largest producer in the United States. And so there's a lot of gas transactions that are in discussion because the valuations got higher. So then the second question, and this really gets into all industries, as Stephen is kind of talking about, if we're in a higher volatile time, what types of mergers can happen? And that really gets into, just as he's saying, relative valuation. It can be two private companies. Some of you are on private company boards. It could be two public companies, where public companies, of course, you know that valuation every single day by just looking at that in the stock market index. And so if you have high volatile times, you can still get deals done if the exchange ratio between those two companies stays really constant. And they might stay constant if the two companies are in similar industries, similar businesses, the revenue sources are relatively similar. Maybe everything outside them is very volatile, but on a relative basis, but it might mean that both stocks are going up or both stocks are going down, but they're going down around the same rate. And it may be a lot better for those two companies to combine. So those are the kinds of transactions we're working on right now, even in these, higher volatile times. And, I may go and, I am planning to go on vacation here in a couple of months, but all joking aside, we're actually relatively busy. But I would tell you, we would be extremely busy if the VIX went down to, I wish it was 18 and it would be a lot better, candidly.